The following is brought to you by Digital Shelf Space, producers of GSP Rush Fit and Tour Academy Home Edition. Visit them online at digitalshelfspace.com.
Okay, ladies and gentlemen, we are now going to embark on the panel. I think we can probably call it the future of the junior resource industry, the future of the TSXV. What the future looks like. Again, for those of you that weren't in the previous panel, my name is Chris Berry and I'm the moderator. To my right, the two gentlemen that will be discussing the issues, and this will be a panel with a little bit of a different complexion. We want to sort of have a debate tonight, and not really a confrontational head-to-head, wrestling match here, but more one where problems are identified and some solutions are put forward. So to my immediate right is Mr. John McCoach. He's president of the TSXV. And to his right, many of you also know Mr. John Kaiser, president of Kaiser Research Online. And so the format, again, for the next 25 or 30 minutes will be as follows. What I'd like to do is, I think we can start off with John, taking 4 or 5 minutes. Or
which one?
This John. Yeah, I might use some last names here. John McCoach giving his take and his view on things, and then having John Kaiser do the same thing, and then pulling some questions and some themes out of that and going forward. So without further ado, John McCoach, please.
Sure, do you want to come up there?
If you'd like to, sure.
I wasn't sure it was the right symbolism to see so much space between John Kaiser and myself. Please don't read anything into that.
All right, I'll move over.
I'm very much looking forward to having the dialogue with John, and as moderated by Chris. And it's healthy to exchange views with people from little different perspectives. But I think you'll find as we go on for the next 20 minutes or so that one thing we don't really disagree on is the challenges that are out there in the junior market, particularly junior explorers right now. We recognize that. I talk to customers every day at the TSX Venture Exchange, and I really understand the challenges that they're going through. And where John and I might have a slightly different perspective is sort of the root causes of the current market cycle, particularly for junior companies. And I think this debate is titled, is it a cyclical versus structural or something to that effect? I apologize, I forgot the name. But of course it's neither, it's both. Like anything in life, it's a combination of a multiple bunch of factors that contribute to our environment. And in my view, the current market cycle is mostly cyclical. But there are definitely some structural issues. There are some opportunities for us to improve our markets, and I look forward to the opportunity to talk about those as we go through this dialogue. But that doesn't mean that there aren't things that we can do about the structural issues. There's a number of things that we are currently doing. In fact, I spend a good part of every day I come to work thinking about what we can do as an exchange operator, what we can do as one of the contributors to the capital markets in Canada, working with regulators, working with our customers, working with investors to improve the situation, not to just help us get through this current cycle, but to improve our capital markets in the long term. And I'm really confident that we're doing the right things, doing as much as we can. But I look forward to hearing John's ideas, and maybe there's additional things we can be doing. So with that, I'll pass it over to Mr. Kaiser.
Thank you, John. I'm willing to concede that if we got a gold bubble going tomorrow, like say gold rocketing back to $2,000, we would be bailed out of this mess that we're in now. However, I think it would just temporarily kick the can down the road. Of the 1,400 TSX venture companies that I cover that are apparently in the resource sector. 721 of them, more than half of them, have less than $200,000 working capital left. That's just barely enough to subsist for another year. There's about 600 companies trading below 20 cents, which have negative working capital, which totals just under $1 billion. Now, everybody's been hanging on, holding, and suspensions, there's been a modest number of them, but delistings, not a lot. But in August, the rollbacks started to go through the roof. Everybody has been of the view that this is a cyclical thing. The bear market started in 2011. It's now through its, we're almost finishing the third year. Such things do come to an end. However, there is no money flowing into the treasuries of these companies. And there's several things that have frightened me, why I think we face an existential collapse of an entire institution. One is a structural change in the brokerage industry about which nobody can really do anything. During the 80s and 90s and earlier, the broker played a pivotal role as an intermediary between the companies and the public. Then in the late 90s, we got deregulation of commissions and the emergence of discount brokers where the public could go and trade cheaply. And at the same time, we got the internet, which made a wealth of information available to the investing public. The broker's role became kind of diminished because they could not collect the 3.3% commission anymore and spend the time with the client who would do a token trade and then go do the bulk of the transaction through a discount broker. So the brokerage industry shifted more to an asset gathering model. And another development in the last decade was a high degree of litigation consciousness where the brokerage firms became very worried about lawsuits because a client bought some penny stock at $5 and it ended up being literally a penny stock. And so now there's a shift underway where there are all these suitability requirements which make it virtually impossible for a broker, a full-service broker, to take a client's orders and execute them. They would rather just a client give them the money, fill out their profile, and then they'll manage the account with whatever the appropriate mix is. This is severing the gateway of money into the treasuries. Meanwhile, the public's out there, it doesn't know what's going on. The regulatory overkill makes it very difficult for the companies to make it very clear or to spell out, at least in approximate terms, what is the prize? What is that little company with that anomaly? What could it potentially mean? If it delivers, what does the stock go to? This is forbidden by rules which are designed to keep the public from thinking that something which is just a speculative possibility is a reality, and you're buying a $1 stock for 10 cents and you're guaranteed to make that money when in fact it goes to 1 cent if that anomaly turns out to be nothing. The third thing that's become very troublesome is that the algorithmic and proprietary trading and the creation of multiple alternative order execution platforms, all to accommodate new technology, trading that's done by programs, by people who day trade. And to make this feasible, the uptick rule for short selling was eliminated. So what we now have is a culture that has recognized the venture exchange whose listings, by their nature of being ventures, has an intrinsic value of zero. They simply have a potential value, a speculative value. Now they can come in there and just sell stock that doesn't exist into these markets and suck up any capital that you may be putting in there. And this has ruined the market as a value discovery mechanism. Now the market is reducing to a simple lottery ticket, and this system is not sustainable. We need to have changes in terms of flowing money into the treasuries. The $1 million accredited investor threshold is too high. You're not even allowed to include your real estate equity in it anymore. This has shrunken the pool of people who can call up that company and say, I like your story, I want to give you $10,000, $20,000, and the brokers aren't playing that role anymore. So I see with this huge cash crunch that we have right now, I see with the metals probably going sideways for several years, I think the system may collapse, implode upon itself, and it's going to get ugly next year because the accountants and lawyers and that which are owed all this money and have let their credit run, when it comes time for the audits next year, it's cash up front, and because there's no aftermarket and for these juniors, nobody's going to put money into them, and we may see a wave of jingle mail. Now, that's not necessarily bad, because there are still about 800 companies out there which I think will survive, and we should focus on making it easier for them to raise the capital to keep themselves alive.
Okay, and on that sunny note, what I'll do now is, from listening to each of your comments, I think, and hearing previous presentations that you've made, it seems like we've got three core issues that maybe we want to take the next 10 to 15 minutes and go back and forth on. And we've talked about this previously, but it would appear that accessing capital is an issue, number one. Number two, regulatory overkill. John, you just talked about that. And the third is, of course, algorithmic and proprietary trading and how that is, for lack of a better phrase, balkanizing this industry. So I guess what I'd like to do now is start with the whole theme of accessing capital. And John McCoach, can you kind of run with that a little bit? Give us your thoughts on it. Is it a big problem? If so, what are some of the solutions? And then, John, you can respond. John Kaiser.
Thanks, Chris. I'm not sure how many of you have sat and listened to panels where the quasi-regulator is the optimist, but can I just comment on a couple of points that John
Absolutely.
made that I thought was a good observation in many ways, but quite selective in some of the facts. For one, brokerage firms haven't been able to charge 3.3% commission for over 20 years. I remember I was in the brokerage industry back then and quite enjoyed that sort of regulated price fixing. But since then, brokerage firms have gone through many cycles, many very good cycles, and on negotiated commissions. So it's something that we can point to that is changing our industry. There's as I said, I think we were led into this cycle mostly by macro factors, commodity prices, investor sentiment, macroeconomics, issues in the mining industry, and I think that's what's going to lead us out of this cycle. But let's say we promised we'd try to focus on solutions. So let me get to those. The accessing capital is, of course, a challenge. That is one of the two main roles of a stock exchange is to be a platform for company, and I'd suggest the most important role of a stock exchange is to provide a platform for companies to access capital. So we take that very, very seriously. In Canada, we actually are very lucky in that we have many tools for our public companies to access capital. There's very few other parts of the world where companies at these stages of development can access public venture capital, and we have a great system, the best in the world, frankly. But there are opportunities to improve it, and a couple of ways we can do that is one with the rights offering system. As I say, in Canada, we've got a great system here, but rights offerings don't work in Canada, and they work in many other countries. In fact, they're the norm, or the first thing people think of when they go to access capital is their existing shareholders. So that's something that we are strongly advocating to fix in Canada, and I think we can make headway there. We will find a solution. That's not likely going to happen in time for this market cycle, to help companies in this market cycle, but we are working with commissions to try to find some interim solutions there as well, and I'm optimistic we will. There's other exemptions. I think we're going to talk a little bit about the accredited investor exemption and maybe the challenges in that. The challenge, I don't think the problem is with the accredited investor exemption. It's a very good exemption, but what we need in Canada is additional exemptions, additional tools. And in our opinion, one of those is an exemption that would be available for companies to access their existing shareholder base as if those existing shareholders were accredited. Similar concept in the fairness that you find in a rights offering, but a little bit different in the process and so on. So we're actually, I'm encouraged to say, making very good headway with that. Commissions are listening. They're actually drafting proposed exemptions to go out for comment. That doesn't mean that that'll happen, but we've been advocating for this for 3 years in the bull market. This is not just a reaction to this cycle. So I think we'll see something there soon.
John Kaiser, can you elaborate on your thoughts initially about accessing capital and maybe respond to some of John McCoach's points?
Yeah, I think making the additional exemptions available so that people can like go to their discount broker and have some forms. In fact, even streamline a system where a company can make documents available to a client at a discount broker. They fill them out, and then the money gets wired to the company subject to a few approvals and that. If exemptions can be created to allow people of a lower net worth to buy, say, $10,000 worth of a stock from the company, rather than just in the market where it's probably sold to them by some algo trader who pockets the money and waits for the stock to go back down, I think this would be a way of dealing with the fact that the brokers can't deal with the small junior companies anymore. The last decade was phenomenal for the TSX venture. 76 or $58 billion was raised through private placements from 2003 to this year for resource sector companies. But the last decade was also something special. The brokered private placements were very important, but it was largely geared towards resource feasibility demonstration. We had the big run-up in real metal prices, which surprised a lot of people. That meant you could do discounted cash flow analyses. All these deposits that had been found in past exploration cycles were dragged out of the woodwork, stuffed into these companies, and institutional investors, sophisticated investors, they said, wow, this will work at these prices. We'll give you money, and a lot of that money was raised. Now we've been through that cycle, and I think we have an interim cycle of discovery exploration, which is much higher risk, which has a much bigger failure potential. And my concern is that the brokerage industry is afraid to touch that type of financing. And so I think making it easy for individuals to give the money to the companies via their discount brokerage accounts could deal with this problem. And then when they have a discovery and need to raise 10, 20 million bucks, then I think the brokers, they will be there because now they can see the trend and the potential values, and it's not like a 1 in 100 shot of having a win.
John McCoach, any response or?
Well, I'm glad to see
comments?
John sees some opportunity, so that's great. I remember when I started in this business in 1981, and just out of university, and talking to some of the senior brokers in the firm that I was with, and they're telling me, you're making a serious mistake. Get out now. Compliance is going to kill this industry. And then I've heard that for the last 30 years. And there's no question there's challenges in the brokerage industry. Their margins are not what they used to be, what we enjoyed back in the day, and compliance costs are going up. But the brokerage industry in Canada is not dead. The brokerage industry in Canada will survive. There are fewer firms than there used to be that are focused on the natural resource sector, but there are still more firms focused on the junior natural resource sector in this country than anywhere in the world. And it really comes down to, I think, John spoke to this a little bit too, if you think gold is more likely to go into $1,800 than $1,200, or if you think copper is more likely to go into $4 than $2, then there's opportunities in this industry, and the brokerage firms will come back. The banks who said in 2003 and 2004, we don't fund junior mining companies, in 2006 and 2007, they were leading a lot of transactions. And if they can make money leading transactions in the next cycle, they'll be there again.
Okay, and so kind of continuing on with that theme, John McCoach, John Kaiser, why don't you start with this one and then we'll go back and forth. But regulatory overkill, that was something that you had mentioned, and John McCoach, you talked about 30 years ago, people were decrying this industry, but nevertheless, we're still here and a lot of money has been made. John Kaiser, your thoughts on regulatory overkill?
Now, I'm not one of these anti-regulatory people. I think the 43101 system that was brought in basically guaranteed at least the survival during the last decade of the Canadian resource junior sector, because nowhere else in the world is the type of technical report filing required. I mean, Australian companies list on the Canadian exchanges so that their audiences can pull from CDAR the technical reports that allow them to make informed decisions. Now, there may have been some overkill in the minutia required and in the fussiness and all that, and I'm not an expert in this area. Half of the technical reports I don't understand. It's about statistical variance, and that's actually like a special section for the geologists, the professionals in the industry who can go in there and read this code and say, whoa, this is a BS, and they can call up the Securities Commission. And of course, the Securities Commission has its whole army of people who pick through this and complain about all this kind of stuff. I think that's a fairly good thing. But some of the stuff like the what IROC does, for example, if your stock closes up in the last second of the day, somebody's on the phone complaining to the company that, well, why are you high selling the stock? Yet when some algo trader taps it down, nothing happens. So there's almost this perverse systemic downward bias to pressure all these little juniors down, because if you can make it all look down, negative and negative, then that helps the trend for down. The whole trading culture out there, I think if we get a bubble, something like gold rocketing, it'll actually help us on the upside, and then we'll get all the bad press where stocks go to the moon like during the dot-com bubble because it's all a momentum game. But I think going forward, the cost of compliance, I mean, the MD&A disclosures of companies, 20 pages. There are actually about 2 pages in it that I find worthwhile reading. All the rest is just butt-covering boilerplate that these poor guys are forced to stuff in there, and that has raised the costs of being a junior company to a level which is out of proportion for the kind of money that we're able to reason this time right now.
John McCoach, any response?
Well, I may surprise John and say I agree with him. There's no question there's a regulatory burden in this country, and we're part of that burden. And we think about almost daily, have we got the balance right? And I know the Securities Commissions and IROC also, think about that all of the time. And generally speaking, I think the answer is yes. What we're told by investors around the world, what we're told by stock exchanges who are looking to create a similar model, is that Canada has roughly the right balance. It's not perfect by any means, but the points you're talking about, that regulatory burden, it's very real, and especially when your company is tight on capital right now, that is it can make or break a company, frankly, and I get that, but nothing has really changed in that world for several years, certainly back last 2 or maybe 3 cycles. There's been no real regulatory burden added. The IFRS might be an exception to that, but that's brought in internationally. That's not something that was imposed by Canadian regulators, or even, that was a trend that was inevitable. It's going to happen around the world, and it did cost money for Canadian companies to adjust to that. But that same regulatory burden has existed through the bear markets and through the bull markets. And in 2006, 2007, 2010, 2011, even going back to 2009, those were the high water marks. That's when companies were accessing capital like they've never done before in this country, and natural resource companies have never done before in the world, with the same regulatory burden. So it's not the the numerator that's changed. It's the denominator, and companies have a smaller amount of capital, and so it's just impacting them more.
Okay, and final point, and again, John Kaiser, we'll start with you and come back this way, was this whole idea of algorithmic or prop trading and its sort of negative effects or dangers on the industry. Can you comment, please?
Well, back in the late 80s, when the Vancouver Stock Exchange developed the first computerized order execution system, I was ecstatic because it took the power away from a very abusive cabal of floor traders, desk traders, and all that, who front-ran client orders. There was no transparency in this market. First come, first serve did not exist. But once it was all based on an order book where you input your orders and they were in the book, and if somebody wanted to hit the bid or take out the offer, you got your fill and nobody could front-run you or anything. This has been compromised by not the stock exchange. I think it's like very high-level Canadian regulators who said, oh, the Vancouver Stock Exchange has a monopoly on this wonderful order execution system. So here you have to allow all these alternative order execution systems that can sit in parallel, and then they force the brokers to be able to hook up to this and somehow shunt the orders through. But there's no consolidated, easy system where whoever was in there first gets their order filled. So this has been a bit of a fragmentation in the market, which has opened up opportunities for this other technology-driven development, which is now computers monitor the order book, the bid and ask and so on, the executed orders, and they computationally can insert orders on the buy or sell side or pull their bids and all that. The regulators are looking at this to see if a lot of this stuff is manipulative, but they'll never be able to prove it. But these junior companies, they are fragile. The promoter, he spends money at this conference, he talks to people, they become confident, the stock creeps up, a news release comes out. It's not the barn burner hole you want, but it is encouraging. You're closer in the alteration system and so on. The stock should appreciate. But instead, the algo traders see this, the computer programs themselves read the news releases, and they can tell whether it's something to stay away from or to hammer right away. So it's become like this big lead blanket suffocating this junior system. And with the elimination of the downtick rule, and they don't even have to flag, these special day trading accounts don't even have to flag orders as short sales, and they don't even have to borrow the stock provided they cover it the same day. And there are rumors that this is not actually enforced, that these accounts do have to be flat. And all of this is really compromising this market as a value price discovery mechanism.
John McCoach.
Well, I hope we're not going to just perpetuate unfounded rumors here, because I think, and I don't want to speak for IROC, but I think they do monitor these things very, very closely. You're right, though. I think that the short sale rule, the changes to the short sale rule in Canada that happened last year should be looked at. We should be closely examining the implications of that and determining on an objective basis whether that was best for the market or not. Basically, IROC's motives to change the short sale rule was to harmonize them with the capital markets around the world that don't have uptick rules. I agree with John that junior stocks, particularly in this cycle, are fragile, and they can be impacted by that. But there's a balancing factor. Others would say, free enterprise thinkers would say capital markets should be about balancing off the interests of people who think a stock's going up and going down. So that's something that definitely needs to be focused on. And the high-frequency trading issue, I think what we have there is we need to understand the issues there. We have definitely a problem in how it's perceived. I don't want to just say a perception problem, because that sounds like I'm minimizing it, but it's not. There's high-frequency traders are second only to dark pool operators, the worst people at branding themselves, and they've become the boogeymen of stock markets, not in Canada, or not just in Canada, but around the world. But the fact is, high-frequency trading only amounts to 1 to 4% of the daily trading volume on the TSX Venture Exchange. So it's I have to question that it's a lead blanket over the market. I talk to traders, I talk to investors, I talk to issuers every day who have given examples of that you just shared, but that is not necessarily high-frequency trading, and it probably is not high-frequency trading. It's probably somebody who has invested in a faster technology, who has an algo that doesn't necessarily have the same trading strategy as the person who thinks that that stock should be going up. And that's just a question of advances in technology. Ever since the trading floors were closed, decimalization was introduced, and computer technology became what it is, that stocks are going to trade differently. Stocks are always going to trade differently. But I agree with you, it's something that we need to monitor very, very closely.
Okay, we have 2 minutes left, and what I'd like to do is devote 1 minute to each of you just for some parting thoughts. John, Kaiser, go ahead.
Parting thoughts.
Deep thoughts with John Kaiser.
I think these problems that we've discussed, there are solutions that are not earth-shattering, revolutionary solutions that can be deployed. And I think all the stakeholders need to look at these problems and look at the simple solutions that can be done and get them into place. We're not going to get rid of algorithmic trading or anything like that. We're not going to change the structural changes in the brokerage industry. And regulation is probably not going to go in reverse. But it appears to be stable in some degrees. And if the costs become a fixed cost and then we can get money flowing back into these treasuries to replenish them, then we get back to what John alluded to, that when the money was readily available, people didn't care about the cost of compliance with this and that because it was just a fraction. It's just that right now everything shrunk down, and it is such a onerous part of the whole process of staying alive as a junior public company. John
McCoach.
Well, I don't want to get too sappy here, but I can honestly tell you I love my job. This business has been in my blood since I was 21, and that was quite a long time ago, but it hasn't been as much fun in the last year as it was in previous years. But one of the things that still encourages me every day is talking to people, particularly outside of Canada. I think an important role of the exchange is to talk to fund managers and trading firms outside of Canada to attract capital to this country to support our capital markets. And even if for those people, those fund managers that I talk to that aren't looking at juniors for their portfolios, they still are very complimentary about what we've got. We have something really, really special here, and it's having a tough time right now, but it will come back. We have the right model, and we have to protect that. And so that when the markets come back, people still see this as a credible junior market, the best place to invest in mining companies in the world. So thank you.
Thank you. Ladies and gentlemen, a round of applause, please.